WeWork India IPO opens October 3rd. WeWork India Management Limited will open its IPO on October 3rd, 2025 with a price band of Rs 615 to Rs 648 per share. The Rs 46.3 crore OFS includes shares by Embassy Bilcon LLP and One Aerial Way Tenant Limited, with listing proposed on BSE and NSE. Report Bilkul Bazaar.
Good morning everyone. On behalf of the board and the management of WeWork India Management Limited and the BRLMs to the IPO, I take great pleasure in extending a very warm welcome to each one of you on the occasion of this press meet and for the launch of the IPO of WeWork India. We at Kotak are proud to be the book running lead manager for the IPO of WeWork India, India's largest flexible workspace operator. WeWork India is a category-defining premium flexible workspace operator, having a diversified member base with a wide range of product offerings and strong unit economics. We strongly believe in company's market leadership and are confident of its growth journey going forward. WeWork India has been the largest operator by total revenue in the past 3 fiscals and has been a key contributor for the evolution of flexible workspace products and services. They lease primarily Grade A offices from the prominent developers across major Tier 1 cities and then design, build and operate them as flexible workspaces as per global standards. Led by a team of experienced professional management that has demonstrated leadership in innovation and execution prowess, shaping the evolution of the workspace industries in India, we believe WeWork India is well poised to deliver long-term growth in Indian capital markets. I would like to take this opportunity to introduce the members on the panel. Mr. Karan Virwani is the Managing Director and Chief Executive Officer of the company. He is responsible for overseeing critical operation and growth-oriented functions of the company and has over 10 years of experience in real estate and property development sector. Mr. Vinay Parmeshwaran is the Chief Investment Officer of the company and has been associated with the company since 2017. He is responsible for financial strategy, M&A activities, funding initiatives, and innovation-related projects in the company. Mr. Clifford Lobo is the Chief Financial Officer of the company and has been associated since 2020. He is responsible for the financial strategy, financial operations, compliance, and overall financial performance of the company. Running you through some key highlights of the IPO. The IPO shall open on 3rd of October and close on 7th of October, with the anchor tranche opening and closing on 1st of October, that is tomorrow. It is a 100% offer for sale of up to 3,000 crore with the Embassy Group and the WeWork International selling partly. The price band is Rs 615 to 648 with a bid lot size of 23 shares. The IPO would be 75% towards QIB, 15% HNI and 10% retail.
Be able to actually continuously move pricing also up. While we move pricing up, we've been able to bring costs down. This is leading to return profiles in the business that is unmatched by anyone else in the industry. We've shown that this business model works and is highly profitable. We've built the business or turned the business from a negative EBITDA business just 3 years back to now a positive 22% EBITDA business. The market opportunity in India is huge. We all know that India is on the way to becoming a $5 trillion economy. This will only happen if lots of entrepreneurship is happening, if Indian businesses grow, and India continues to be a place where global businesses hire talent and continue to take space. This leaves India in a very unique place when it comes to commercial real estate. The amount of supply in India for real estate versus the population, the growth of the demand, the amount of people moving from small towns into metro cities is leading to a shortage of supply and a huge amount of demand, which you can see in the demand and absorption trend graph. India continues to be a place for global multinationals, GCCs to grow, but we're also seeing domestic businesses grow drastically. In this light, flexible workspaces has grown from a 0% contribution to nearly 25% contribution of commercial real estate. almost the same as IT and ITES, which was for a long time driving the commercial demand in India. You also see that the demand itself is changing. Companies want flexibility. They want a hospitality led approach to the office space. Companies want to give a hub and spoke model to their employees. They want to have the office, the environment of the office be so great that they can attract the best talent, and actually the best talent stays with them. There's a lot of focus going into health and safety, into ESG in the workspace, and also diversity in the workspace, which has given the rise to flexible workspaces that has grown from 0% just 5 to 6 years ago to now 10% of total commercial real estate. And it's continuing to grow. We think this gets closer to 20 to 30% in the next few years. Now, like some of the other asset classes in real estate, like hospitality, warehousing, data centers, where you've seen a branded operator-led play drive the market, the Hiltons, the Manipal hospitals of the world are bridging the gap between what the changing demand is to the underlying asset class. In commercial real estate, landlords need to get rid of as much space or lease a lot of space for as long as possible. But companies want short-term space, they want flexibility, they want the ability to scale as their business grows, they want the ability to shrink as their business goes through bad times. And operators like us are able to come in and actually bridge the gap between the two. Now we have few key differentiators, starting with the brand itself. WeWork is, like I mentioned, synonymous with co-working. It is a category defining brand. WeWork continues to be the space of choice for a variety of reasons across some of the largest businesses across the world. People search online, is there a WeWork close to me? More than they will search, is there a co-working space close to me, or is there an office space close to me? The recall of the brand is organic. It is anything, it's organic, and it's actually a global recall that we have. Not only do we have this category defining brand, but we have the team that essentially built the category. This is the team that has been with me for the last 8 years. We've seen COVID, we've seen whatever happened with WeWork globally, and have built the business to be a lot more resilient. Our second biggest differentiator is our location strategy. We see that most of India's talent continues to move to the top 8 cities. We see that India's biggest companies continue to grow within the top 8 metro cities. We want to continue to grow deep within these cities itself. All of this real estate today is controlled by 16 large developers. Your Prestige, DLFs, Embassies, Rahejas of the world, Panchils of the world are driving the entire market. We have multiple deals across all of these major developers. 95% of our assets sit in grade A commercial buildings. And through these relationships, we're able to get better deals. We're able to see real estate that is coming much further out and get better commercial terms. You'll see that our presence mirrors where most of the commercial leasing demand is. Today, Bangalore, Mumbai, Hyderabad are some of the top 10 leasing cities in the world, not just in India, and our presence is deep across these cities. The third biggest differentiator is our product suite. Like I mentioned, we operate and have built the business for all types of companies, and we also want to build the business for every type of need that the office has. So you can come to WeWork and get a desk for a day, an office for a month, going up to a fully large-scale bespoke managed office for multiple years. 80% or 85% of our revenue comes from the first bucket of products, which are start from plug-and-play offices that you can just enter as a single entrepreneur. You can grow to a few hundred as your company grows. We customize these spaces, we create office suites, can give you a full service floor.
Thank you, Karan. Good morning, everyone. So in this section, I'll talk to you about a few key themes or pillars of the business. We'll cover the growth of the business. We'll cover some operational metrics of the business, our revenue profiles, how we manage to control our costs and our margins, as well as how we've managed to de-risk the business. Right. So let's jump straight in. Here we really showcase the growth of the business, right? So on the left side we talk about supply, the right side is the demand. So you can see that between March 23 and March 24, we added about 15,000 desks. Between March 24 and March 25, we've added about 20,000 desks. And even in the last quarter, we added about 5,000 desks, which is an annual run rate of 20,000 desks. 20,000 desks translates to about 1.5 million square feet that we've consistently managed to add. What's interesting here is in the financial year FY25, we added 16,000 desks in just 4 months, largely 4 months of the financial year, December, Jan, Feb, March. That's more than 1 million square feet. It shows our ability to deliver desks at will and ability to scale up the business. The right side talks about demand, and demand has clearly kept pace with supply, right? So what's really interesting here is that more than 50%, about 52% of our business came from existing clients growing with us. 96,000 desks out of a total of 1,14,000 desks sitting in our mature centers. And that's roughly 85% of our portfolio. And why that's relevant is on the right side. You can see that our mature centers tend to stabilize at about 85% occupancy levels. You'll notice a slight dip from 85% to about 81%. And you can see that that continues to move up. The reason for that is on the left side, right? You can see that between March 24 and March 25, we had a whole bunch of about 15,000 desks moving into this market. But this trend has again continued to move up, and we are confident that this will move back to historical levels of about 85%. Now, why are these mature centers important, right? So having such a high proportion of well-performing centers at 85% occupancy obviously leads to a few things, a couple of things. One is that our break-even occupancy levels at a center level are now just 55%. So the moment a center is half full, it turns profitable, right? And all incremental revenue from 55% all the way to 85% is margin for the business, right? Secondly, it acts as a very strong, profitable set of centers, which is a great base for our business as we open new centers and move into growth. Here we not only talk about our revenue mix and how our revenues have grown, but also the various streams of revenue that we've managed to unlock. The first graph is a summation of the bottom three and shows our revenue from operations, which has clearly grown between 20 and 25% compounded year on year. The second graph is the largest part of our revenues, which is the revenue that we get from our core operations, which is space as a service, right? The third and fourth are really interesting then, because service and ancillary revenue for us is between 11 and 12% consistently, while the industry average here is significantly lower, which shows that we are able to command a lot more wallet share from our customers compared to anyone else in the market. The last piece, which is the membership revenue India is 115, is the revenue from our digital products that Karan spoke about, which is where you can go online and buy a day pass for a center near you or buy a virtual office for a business address for you. That's between 3 to 4% of our revenues, but it contributes nearly 20% to our EBITDA because it's a very high margin business, and you can see that it's growing really, really fast, right? So in a nutshell, not only have we managed to unlock a lot more wallet share from our customer, we have also managed to unlock a lot of unique revenue drivers for us, which is growing faster than the underlying business itself, which is growing fast. And while everyone else is trying to expand their businesses, their top line and bottom line by just adding new centers, investing more capex, taking on lease liabilities, we are trying to actually go deeper into the wallet share and unlock a lot more adjacencies, which no one else is really succeeding to do as well as we are. So building a profitable business is not just about expanding revenues, right? You also need to control your costs well. So this business obviously requires a lot of capital expenditure upfront to expand the business. And hence, if you look at the drop in capex cost from 1.6 lakhs rupees a desk to 1.3 lakh rupees a desk, it's hugely significant in making us a lot more capital efficient, right? And not only the upfront cost, if you look at our ongoing operating costs on the right side, we've managed to always control that between 23 and 24%. Now as the occupancy level, so these are largely fixed costs, right? These includes common area maintenance that we pay to our landlords. It includes housekeeping costs, electricity costs. So these are largely fixed in nature. And as our occupancy rises, obviously this as a percentage of revenue will fall.